as we had seen the progression of the stimulus is working and companies executing and leveraging correctly, they got great results, as they should. And in the second week, you're going to be watching for that one, Semiconductor LLTC, JP Morgan. Oh my goodness, people, with FinReg. If you're familiar with the FinReg bill, I know that SMF Street and its worldwide network is very familiar with it. They're, over the next year and a half, they're looking for huge layoffs in the financial services industry. Because basically the way I see it in America is that the rich is being penalized for doing well, and the less unfortunate are being rewarded for not doing well and have no true meaning of wanting to do well. Because, and I'm not saying that in a bad way to our U.S. consumer base in our structure in America. What I am saying is, though, that everyone needs to get out and contribute to the workforce, including the way that this was built, the way that the U.S. publicly traded companies and everything that's in the land. Everyone needs to get together and do the right thing. And does that come? Maybe it does, maybe it doesn't. It won't come if you don't change policy. And outside of all of these earnings is the key factor of forward-looking guidances. So was it maybe just a 3-month slowdown? Well, the Federal Reserve is going to make sure that they re-stimulate so they don't lose all of the good things that happen in their eyes and their belief. But for the taxpayer, I don't see it that way. I'm sorry, and I'm not going to agree to it. The thing that I see is that the banking system got what they needed. Corporate of America got what they needed. Everybody got what they needed. GM got what they needed. AIG got what they needed. Citigroup got what they needed. And the laundry list is long. Good bank, bad bank, low rates, monetizing debt, doing all kinds of things. But publicly traded companies could care less because what they do is they continue to leverage on all of them failed events. Basically, the stimulances are wearing off. That's why the growth rate is down. And we peaked during your taxpayer dollars gave Wall Street a big bang. Yeah. Do I agree with it? No. What do I agree with? I do agree with people being able to go back to work. That's what I agree with. And every one of these publicly traded companies in America should be working in that direction instead of going offshore. New policies need to be written to bring those workers back. This is a retail stock. There's different stocks. So we know what's going to happen. JP Morgan is going to be a big, big drop over the next 6 quarters around the world, but particularly in the U.S. It's not a good bill, and I hope that they can override a lot of it, but they can keep the risk management curbs in for the consumer. So let's not get that wrong. One of the things that Google, Eric Schmidt, was kind enough to come out and agree with stockmarketfunding.com. He came out and he says, well, for the next several years, we see a lower growth rate. Seasonality, that at times, like in the June quarter, or when they were coming up into the July one, but you know, Google does different at different seasonality times. So when we were having that slowdown, maybe their searches were a little bit weaker in their business model and what they do. I can tell you, though, that, yeah, they have positioned themselves well for that slowdown growth. And he sees several years of it. That's what we've been telling people. Until, does it have to be several years? No, it doesn't. J.B. Hunt's a trucking one. We're going to be watching that. And the transportation sector. Just like we have a video on our website that we did a few weeks ago on FedEx in the transportation sector. Why was FedEx important to the MMTs? Was because FedEx sends a lot of things around the world. And FedEx is, and we're seeing inflation in FedEx because they're raising their prices to meet that lower demand, so that they too can re-leverage their earnings cycle up by charging you to make those earnings. And the kind of cost that every one of these different publicly traded companies pass on to you as the consumer to make those numbers. Instead of passing on the cost to you, they should be helping re-leverage the American consumer, who has been in a deleveraging environment. So during this earnings season, we're going to be taking a look at the very finite differences between U.S. and global earnings. Not every publicly traded company is diversified in other parts of the world. McDonald's has done well, so has Walmart, Intel, they've done well. There's a lot of them that have benefited. I'm not going to go into what the currency rates mean for each one of these in the earnings. We'll do that off video and during the actual live event as it comes and we get ready to trade it. There'll be lots of headlines. There'll be lots of upgrades. There'll be lots of downgrades. There'll be lots of gimmicks. There'll be pros. There'll be cons. There'll be everything that you can imagine that they can do to throw you off. But guess what? They can't throw you off, MMT, because you're being trained to be an expert. And you're very, very, very biased, meaning that, look, there's a time to be a bull, there's a time to be a bear. So therefore, because of you being extremely biased, can put you on the short side of an earnings drop or a good report where there's a trade and you got a gap up, you wait for it to pull back. Good trades, good momentums, good trading opportunities will arise out of weakness and strength. So this is the second week, and it's an options expiration week. And we'll be doing that Google trade. We've already traded it 6-7 times in its uptrend. And when it does get ready to go into the cycle, we'll be doing special positions, both up and out of the money and below the market, using our risk management tools. Because once again, we don't teach our SMF Street traders to totally be consumed with one belief. Even though the belief may be correct, that's fine. You're still going to make money. But for some odd reason, if that belief is not there and it goes the other way, you're going to cover your dollar capital risk to the upside and end up making money on the downside. So therefore, because of your superb risk management skills called dollar cost risk capital management, directly related to the MMT and the firm, the SMF firm. I will tell you that we'll be doing lots of more specials on these earnings as we move forward. Today we're going to go do the Google chart. Today we're going to take a look at where some of the semiconductors need to lead rallies, but if the semis are weakening up in the supply chain and, you know, financials were really not participant, now where is that financial community? And what is the financial services community going to do? Going to lay off more people because they got to leverage their earnings. That is still a much lower growth rate environment, because if things were good, then you wouldn't be still continuing to lay people off to leverage the earnings. They're supposed to deliver to you, the shareholder. But what is the pro and con? Yeah, you as a shareholder in the name, you know, they're to produce for you. But there's a lot more to it. And it's very much deeper, intrinsically more to it. And there's a fine art. There is a fine understanding of what goes on. And we're going to be going through that. It's going to be a good season. So what we're calling for is not a total collapse. We're not telling you that. But what we are going to teach you is where they have peaked and they start to decelerate or diminish in the key parts of guidances and where revenues are coming. And once you're trained on that and you see that, we've already told people that going into the next quarters can be challenging. And once again, when something starts bad, or starts going in another direction, it starts gradually and incrementally, just as it does when it's going to be good, as it has the last 6 quarters. But what about the next 6 quarters? That's what we're talking about. And that's what we're going to do. We're starting a brand new 18-month database. We'll have, over the next 18 months from the financial crises, we got a database there. We'll have database number 2. We'll have exactly where everything is globally. We'll have exactly where everything is intrinsically in the U.S., where revenues come from, where the consumer is, and everything else, and the guidances. Are the CEOs as bullish as they were when things are working? That's going to be a key, because remember, the manipulation is that stocks, in my view, going into this earnings season, the reason why we're shorting gaps, we're shorting the good news, no matter what, 100%. But then again, that is more when the company reports. There's a big knee-jerk reaction to that upside in after hours or to the downside in after hours MMTs. And the new MMTs here need to go back and find out after hours earnings trading videos. There's a lot of them that we cover there live that you can go back and see what was happening during the last quarterly earnings for the new ones that are going to go through their first round. It'll give them a great idea and a great understanding of what it's going to be. SMF Street is calling for weaker growth. We're calling for lower guidances or diminishing guidances compared to the last 18 months. It'll be the first month of the new 18-month cycle. It starts somewhere. And lower growth is lower growth. And lower yield is lower yield. Higher yield is higher yield. And we have a formula, mathematical formula. It works 100%. That's not going to be talked about on the video. It's too proprietary. I'm going to conclude this kickoff. Gap ups, gap downs, trade management, risk management, options trading management. Everything will be applied to the SMF Capital Risk Management Trading Program.